Okay, good afternoon. We're continuing on with the session here. The next presenting company is Artemis Gold. They own the Blackwater mine located in northern British Columbia. In January of this year, Blackwater achieved the first gold pour. Commercial production is on track for Q2 of this year. The company's expansion study outlines an average annual production in excess of 500,000 ounces in the first 10 years. Presenting on behalf of the company's chairman and CEO, Stephen Dean.
Thanks, everybody. Thanks for being here. Thank you, BMO, for hosting once again. I need to show you that. Most of you are familiar with who we are, 100% ownership of the Blackwater mine in central British Columbia. Fully ramped up, we will produce more than 500,000 ounces a year at very, very competitive lower quartile cash costs. One of the unique facets of Artemis and our predecessor companies, in fact, is the focus we have as board of management, primarily because we are large owners of the company. In this case, we own about 38% of the business, and so that keeps us very, very aligned, perhaps more aligned than most in our sector, and we treat our share capital with the greatest level of preciousness. Pleased to say we did pour gold last month, and we are in ramp-up mode. I'll talk about that some more in a minute. We've got a great team. I'll show you that picture there of some very dedicated, handsome men and women who really are responsible for achieving what we've done over the last, I think, 4.5 years since we started the business, and less than that since we acquired the project. Great team. Principally, if there is a theme in this team, it's the fact that a lot of senior background. So we're a senior team within a junior but growing mining company, now producer. The other key tenet of who we are is we protect vigorously the theme of our business approach, and that is that we do absolutely our best to deliver what we say we're going to do. And there's a list of things that we have done over the last 4.5 years. It's been a busy 4 years or so. And the last one there you can see is the box check on the pouring of gold in last month. Here's some current pictures of what the mine site looks like. We are on track, continue to be on track to achieve commercial production in Q2 of this year, next quarter, I should say. If there is anything we've learned in the last 4 or 5 weeks of ramp up and startup of operation, and particularly the plant, is that there is every sign that what we have built to date in phase 1 will comfortably achieve nameplate. And I mean specifically in terms of crushing capacity and in terms of milling capacity and the rest of the wet plant. I know some companies in the sector have found out that there are shortfalls in some aspects of what they've built and engineered. We have no sign of that. In fact, we're seeing the early signs of an ability to achieve at least nameplate and perhaps beyond. We've also been helped by relatively favorable hardness of ore. So our crushing circuit, in fact, is doing very comfortably around the 900 to 1,000 ton an hour, which is in excess of the nameplate that is on that circuit at the moment. Next quarter, we will also issue our production and cost guidance following commercial production. And as soon as Jeremy, our president and COO, gives me the nod that he's happy with the stability of how operations are doing, and plant in particular, then we will table an investment decision to proceed with phase 2, which will bring us from a 6 million ton per annum nameplate capacity to a 15 million ton per annum operation. Construction time approximately 18 months once we hit the button on that construction decision. For those of you who haven't seen that, that's what our 3 phases of production expansion look like, starting at 6, which is what we've built to date. The next stage would be to go to 15 and then to 25 million tons per annum. We have permitting to do that. This slide actually breaks the mine life up into the first 5 years, first 10 years, and then life of mine. But as you can see in this slide, it more precisely shows the profile of production with that those blue bars well in excess of the 500,000 ounces per annum production based on this timeline of expansion on phase 2 and phase 3, and very, very competitive AISC. I once glibly said, in fact, at this conference last year at a Kitco interview, when people asked me, how do you get a low-cost, long-life mine? And I said, you got to build a new one, and I think there's a lot of truth in that. These are the 3 phases. These are the growth capex to achieve those. You'll see the capital intensity per ton of throughput is very competitive and compelling, particularly at the current gold price economics. And talking about economics, here's some sensitivities. When we did the feasibility study, the expansion study optimization, which we only issued in February of 2024, it seems like decades ago, we used a long-term gold price, which I think was consensus at that time of $1,800. The consensus gold price is higher than that today. I think it's $2,100 or $2,200 amongst most brokers and analysts. But at spot today of circa $2,900, that implies, based on that expansion study scenario, a NPV increase to 6.3 billion Canadian dollars, which is a very significantly higher number above our current market cap. I won't dwell on this too much, but suffice to say we have the advantage of green BC hydro power, and so our carbon emission is one of the lowest in the industry, and we have the potential to even lower that as we look to electrification options for our mining and haulage fleet. The other important aspect, and Lundin Gold is a perfect case study for this, is that they've achieved all the things that they said in terms of production and cost profile, and now they're in that, oh look, there's another deposit over here potentially, oh there's an extension of this deposit. I can see us following a very similar playbook whereby we will be drilling sometime over the next year or two some of these extensions to the current mineralization of the main ore body at Blackwater. You see it's not closed off to the northwest and also to the south. And there will come a time shortly when we'll put some holes down there and we'll hopefully see where that mineralization goes. But even if we don't drill a single hole, I saw Newmont yesterday or the day before increase their reserve gold, the price they use for their reserve calculation from 1,400 to 1,700. We use 1,400 for Blackwater. I'm not sure the next time we'll revise or re-optimize this, but if we used a price of $2,000, which is currently below the consensus, believe it or not, today, simply by pressing a button on a re-optimization without spending a single cent on another drill hole, we have the potential to convert measured and indicated resources of 3.2 million ounces into reserves purely by re-optimizing at more recent gold price. We have a fabulous list of shareholders, including a very strong ethos of board and management ownership. Meg, our capital markets VP, likes to point out that our our average daily value traded has increased, in fact, doubled in the last 3 or 4 months. So for those of you that didn't buy because you were worried about liquidity, you no longer have that excuse. And a very fine banking organization called BMO did some analysis. Some of those people are in the room here who did this analysis. This tells us that if we simply approach the average PNAV of the junior producer field of a number of North American and Australian producers, we will go from a current 0.69 to a 0.85 PNAV. And if we select the star of that group, being Lundin Gold, at 1.4 or 1.45 PNAV, and by the way, we hope to have a similar production profile and cash cost and AISC profile as they currently have once we achieve full expansion to phase 3. There's a suggestion that we have a lot more to go than the current re-rating and trajectory that we're on. I'm going to wrap it up there in case there's some questions. Andrew.
Thank you, Stephen. We do have a very short minute if there's a quick question from the floor. Maybe you just
I know you have one.
I've got one. I'll take over. You just hosted a virtual site visit for the sell-side analysts. I think you'd be instructive because there were some discussions on the phase 2 in terms of next steps, in terms of updating economics and then timing of making that decision. I don't know if you wanted to kind of go over that in more detail in the little minute that I've got left.
Yeah, a couple of things. One, we hope that Andrew's just mentioned that we hosted what I think is an industry first. We had Jeremy Langford, our president and COO, with some earbuds, and one of our other geologists running around with a gimbal and an iPhone, following him around the plant, talking to 10 or 11 analysts who follow us live. Then we went with our capital markets director, Meg, switched a button on Teams, and then we went up to the mine site, and then we went back to Jeremy in a different part of the plant, and it was a really, really cool exercise. We didn't know it would work. It worked really well. We're going to put it on our website if you want to have a look at it. It was a lot of fun to do, and I hope it was instructive. Answer your question, because we're out of time. The economics are even more compelling than they were 12 months ago for that phase 2 expansion. And as you know, we are very disciplined about spending and committing to that, provided we have the cash flow generated to do that. With this gold price, that really helps. I want to get it stable. Jeremy wants the operation to be stable, and then we'll put that proposal to the board probably in late Q2, early Q3, and we'll tell you about that decision around then.
Well, we all look forward to it. Thank you very much.
Thank you.